Welcome to the Lend Academy podcast, session number 34. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I'm delighted to welcome someone who has been around this industry far longer than me and someone who was really around from almost the very beginning. Michael Solomon is the CEO and co-founder of CircleBack Lending, but CircleBack Lending was not his first go-round in this industry, and we're going to delve into that in this podcast. He's certainly got some battle wounds, shall we say, from the early days. But I think, as you'll see in the show, that it's made this venture at CircleBack a much more solid venture, and he is starting to enjoy some success. So we'll delve into that and much more in this episode. Hope you enjoy the show. Welcome to the podcast, Michael.
Thank you. Thanks for having me.
Okay, so let's get started. I know your background is a little bit different to everybody else that I speak to, insofar as you've been in this industry longer than I have. So can you just explain a bit about your background, what you did before you discovered peer-to-peer lending, and then a little bit about what your first venture, what happened there, and what that was about?
Sure. So back in 2007. When I had seen Prosper and Lending Club emerge, I thought it was a really, really clever concept, and I was intrigued by the model. And prior to that, or right around that time, I was both running a network of attorneys that provided legal and financial services through a host of different organizations, whether it was being the back office for behavioral health care consultants or, serving the bereaved families at funeral homes across North America with estate planning. And at the same time, I was running a niche immigration practice that I had built that got all of its customers from online acquisition. And I became very interested in online acquisition and, sort of this concept of lowering the playing field, lowering rates, providing better rates and quicker customer service was kind of something that I was used to from the days with my legal services operation. And that's what that was all about. It was about disintermediation and lowering, the cost of legal services. And I thought this was interesting and decided to put my hat in the ring, so to speak. And I had built a few websites and had a lot of knowledge about marketing, but really never embarked on such an ambitious project, like that. And the company that was born, it was called Lonio. And I spent the better part of 2 years spending all of the money that I had saved and leveraging my credit by hiring teams overseas that I then project managed here to build out all of the infrastructure and technology platform. And I guess it was in 2008, in the fall of 2008, finally launched the platform. And around the time that I launched was around the same time that the SEC had ruled against Prosper and decided to send them a cease and desist, as everybody knows, and as the history goes, because they did not agree that, selling loans to people, with $25 a piece was, essentially amounted to selling an unregistered security. So at that time, we had to go dark as well and, proceeded to then figure out what we were going to do and actually drafted our own S1 registration statement, which was what the SEC was requiring. But because it was the year 2008 and because, frankly, Lending Club and Prosper still hadn't proven their models out and were really spending tens of millions of dollars, it became a very tough environment to raise outside operating capital. And ultimately, at the end of the day, through subsequent amendments that we made with the SEC, I was forced to make a decision where either the next amendment would become our effective amendment, which meant we could start operating again, or I had to withdraw it. So because I was unable to raise more money and didn't want to do anything that would be, grossly negligent and irresponsible, I had to withdraw the statement and, move on to to my other businesses and sort of put it on the shelf.
Right. Right. So, and I think I just want to be clear here. I mean, you basically drafted that S1 by yourself, right? That was, you're obviously you're an attorney, so you're able to use those skills to do that. I mean, so you weren't hiring a law firm, right, to draft that S1?
No, we didn't. At the time, I mean, I really had, I was really operating the company hand to mouth, with all of my own capital. And we didn't have the money to go out and hire a white shoe firm. And right after I had launched the company, I had brought on a guy by the name of Todd Walters, who is now the COO of CircleBack. And the two of us essentially locked ourselves in a room and more often than not spent many hours at Panera Bread and a diner up in Rockland County, New York, just drafting this crazy document. And, it certainly was a learning experience. And it's kind of funny, at least I could put under my check boxes of accomplishments that I drafted an S1 registration statement, and it almost became effective. But
right.
It was a daunting task. I mean, not only from just the disclosure side of it, but also the whole financial side of it, because even though our financials were light at the time, you still had to go through the financial review as well. And it was certainly a very good learning experience. And, I think now if we had to do it again, obviously it would be easier for us to do it, and because we understand the mechanics of having to go through it.
Right. Okay. So you had unfortunate timing, really. I mean, you had not just the Prosper cease and desist, you had, the worst financial crisis in 75 years sort of unfolding as you're going through all this. So it's interesting to me that, you came back. So, I mean, you obviously, this was 2008, when we first chatted, I think it was like 2011 when you were still, Loanio.com was still an operational website. So you obviously took some time, like you obviously went and did other things. What happened in the interim? So after 2008, you did your S1, and that was, I guess, 2009 by the time you got all that done. Then you decided to withdraw. Then, what happened before you decided to go launch CircleBack?
Well, even after we withdrew the registration statement, I was still hopeful that, I might raise more capital and things might turn around. But for quite a while, I'd field a lot of calls where people would say, oh, yeah, we want to give you money, and yeah, we want to do business. And they basically mostly never led anywhere. And I then got a call from a group about 2.5 years ago, 3 years from now, that had made a lot of money in online lead generation. And a lot of it was sort of in the near prime, subprime space. And I guess they really saw the writing on the wall with the regulatory framework that we now find ourselves in. And they were looking to diversify, and they said, hey, would you be interested in getting back involved in this? And around the time that they were asking me was around the time when you finally started to see some movement, positive movement at Lending Club and Prosper in terms of, signs of growth and profitability being around the corner, with the large groups coming in to start purchasing loans that really help to drive their businesses forward. And I jumped at the opportunity to get back into it because I almost felt like I was cheated in a way. Like, I didn't really get a fair shake and a fair chance to be a part of it. Obviously, I took a lot of personal sacrifice and financial sacrifice because I had spent really and leveraged myself really as far as you possibly could. It was almost like a movie.
Right.
So, I was given this chance to do it, and I jumped at the opportunity, and, so far so good. I mean, we've come a long way, still have a long way to go, but I think that the environment and the economic climate is much better than it was the first time around.
Oh, for sure. So what do you think now that you've like, what did you learn? You obviously, this is your second rodeo, and no one else in this industry has done this for a second time. How has it helped to have done this once before?
Well, I think that a lot of the times, and I'm sure you could appreciate this, really being an insider, that a lot of the times when you have discussions with folks that don't really understand what's going on with these businesses, is that they don't understand it. They don't understand really how sophisticated and complicated and complex the processes are, the regulatory frameworks are. There's state and federal regulation. There's, 6 different layers of regulatory agencies. There's, the loan purchasers and balancing the mix of, pricing and underwriting and portfolio management against, the marketing needs. And, oftentimes these things conflict with each other, and building out the technology and being able to responsibly scale, in a way that makes sense, and product develop, it just goes on and on and on and on. And, at the end of the day, the question is this, a financial institution or a financial company or a consumer finance company that's technology enabled, or is it a technology company that's doing consumer finance? And, it really is at its core, first and foremost, the consumer finance company, because if you can't do those things properly the way that they need to be done, then it doesn't matter how good your technology is. Right. So,
Yep.
So it's a little bit of everything, but I think, looking from the outside, it's easy to say, oh, let's take a few $1 million, get a couple of guys with MBAs from Stanford, throw them in a garage, and, we'll have a platform up and running and everything will be great. And when people dig into it, and I've seen it, and I'm sure you've seen it too, a lot of folks coming and going, it's a lot more difficult than that. And I think, a lot of what I learned when I was with Loanio has certainly been very helpful in building this new business and making decisions properly and learning from mistakes that were made, or at least understanding how to build a proper foundation to do this the right way, instead of, going off, half-cocked that,
Right.
I'm not suggesting people are doing that, but,
Well,
there's probably going on.
Yeah, I think I probably get an email. I get an email at least once a week, probably twice a week on average, from new entrepreneurs who are thinking it's, how hard could it be? Thinking about hiring a program in India to create yourself an online platform, and away you go. But, as Ron Suber likes to say, this is a lot harder than it looks. And I think you hit the nail on the head. I think if you don't have the risk, the underwriting piece down, and like consumer finance, I like the way you put that. It's really, consumer finance is central. If you don't have the risk piece down, one, you won't be able to raise any money because no sophisticated investor is going to invest with you. And if you are able to raise, some money from unsophisticated investors, you're probably going to fail in the long term, because the underwriting is the number one piece. So I think that's great. So,
And, just to add to that, and it's more than just the underwriting, right? It's everything that surrounds that. It's compliance.
Sure.
It's having somebody that understands compliance. It's the regulatory framework. It's auditing. Every one of these little things, you're going out to institutions to put tens of millions of dollars on your platform. You better bet that they want all these things in place, and they want experienced people that know what they're doing, because it's not kids play, and we're not making widgets here. This is serious business.
Right. Okay. So let's move more to the present day. Can you just explain to the listeners, what CircleBack does and how you're different to Lending Club and Prosper?
Sure. So, again, and I guess part of this was just from experience, taking the experience and then leveraging it, and then also just where we were in the marketplace when we started Loanio. When we started, Loanio versus CircleBack lending. But because there had been such a movement away from retail and more, the things that were driving the two other, what I like to call direct competitors, because I think anybody that makes a loan is a competitor. But if we're going to say direct competitors like Lending Club and Prosper, we saw that there was a lot more institutional interest in coming to the platforms. And at the time when we decided to take on the role of building out this new platform from scratch, which we basically did, I didn't take anything from Loanio. We made a deliberate decision not to enter the retail marketplace, because we felt that it would just be easier for us to go the institutional route, and it just seemed to make sense. And we wanted to, that was one of the differentiators that we wanted to carve out. So we built the platform with the institutional investor in mind, and decided we were only going to sell whole loans to institutions. And one of the other things that became a differentiator in addition to that was, not only were we going to sell loans to institutions, but in the beginning, at least, we were not going to cater to the groups that were geared up to, do high frequency kind of cherry picking trading, as we like to call it. So what I mean by that is, as you know, and I don't know, it sounds like this is dying down a little bit on at least some of the other platforms, but there was sort of this cottage industry of funds that popped up that all had their own underwriting teams and data analysts. And, they would come into these other platforms and say, well, we figured out a better way to underwrite the underwriter, right? So we found little pockets that we could exploit. And we think that we know that, for simplistic terms, that people that have brown dogs are more likely to pay their loans back. So we're going to buy all the loans with people that have brown dogs, right? So, and that works to some level at a micro level, but, you can't scale that way because, even if you're lucky and you do find a pocket, once you start to scale, you have to expand the box that you're underwriting to, and it's just not possible to scale that way. But more importantly, as our chief credit officer, Alan Shipris, likes to point out, if you use the analogy of playing with a deck of cards, it's like playing with a deck of cards, but you don't know whether some of the cards have been removed, right? So if you have there's 52 cards in the deck, I think, and if you have a deck of cards and you're playing cards, but you don't know if the guys next to you removed half of the tens and, 3 of the fours, it changes the probabilities and it changes your predictability. It changes cash flow predictability. It changes, it makes the population of loans unstable because you don't know what everybody else is picking.
I just want to be clear about that. So basically, when investors sign up for CircleBack, obviously they can give you, I presume, some sort of criteria that they're interested in, or how does it actually work? Obviously there's no cherry picking, as you said, but
right. Yeah. So right now the way it's working, Peter, is that everybody that is buying from us is buying platform wide, and they've bought into our underwriting and pricing capabilities. And what will happen as we continue to grow is that we may decide to let people, instead of cherry picking within each credit grade or segment, we may start to just sell certain segments.
Right,
so,
that's what I was getting at.
So for argument's sake, let's say we have A through H's now, right? So at some point we might say, okay, you could just buy the B's through the H's because we're going to sell all the A's to the people who really want only the high quality, low risk, paper, right? But now, because of the way that our business model was built and our inability to take whatever, institutions might not want and sell it in the retail marketplace because we don't have the retail component, it became necessary for us to build a model that required everybody to buy platform wide. And, obviously all these different models present challenges. And one of the challenges that, one of the hardest things that we had to do for a period of about 12 months, about a year and a half ago, was fend off and reject a lot of offers from funds that wanted to come in and cherry pick. And we could have very early on taken tens of millions of dollars from folks if we would have allowed that. But it didn't seem to make sense to us and wouldn't have worked very well with the business model. And we held out and, are kind of glad that we did, because I think what you're seeing now is that, well, at least what we're seeing is that some of these groups that came to us and demanded that that's the only way they could work are now coming back and saying, hey, maybe you were right. Now it's more about access. So we have to go out and sell access to our limited partners, and not the idea that we're going to get the extra 100 basis points because we're the smarter guys in the room.
Right.
So it's been an interesting shift, and I think we bet right. I mean, it was a bet, but
Right. Yeah. So you launched in the like this. Well, you started off with a beta program in the summer of 2013. I follow. There's articles on Lend Academy that follow the evolution of CircleBack. So then you raised some equity, but the big deal. You were going along for a bit over a year, and then you signed the $500 million commitment from Jefferies, which was obviously a huge game changer for you. So can you give us a little bit of an idea of what your loan volume was like up until September of last year, and then what's happened since then?
Sure. So prior to the announcement of the Jefferies deal, we had funded approximately $4.5 million worth of loans during a 12-month beta test. And that was from mostly friends and family. and one or two small funds. And after we announced the Jefferies deal, we really started the business, once we had the capital to deploy in October of last year. And to date, we've been growing nicely month over month. And I think we have about $71 million of loans originated to date. And this month we should do $18 to $20 million. So we're growing at a nice growth rate. It feels good and comfortable. We haven't started to turn the dial up yet, but we're getting to the point where, we feel very confident that we could start to turn the dial up and really increase the volume. And if you look at the benchmarking of some of the other platforms and their origination growth, I don't think it's that much of a stretch to imagine that, where we'll be in, by the end of this year. And we fully expect to be at, $75 to $100 million a month by the end of the year.
Okay, that's some rapid growth right there. So, are you looking for new investors now? Like as far as in the loans, are you? Jefferies obviously have made a big commitment. But if someone listening to this says, we want to investigate this, you're taking on new investors.
Well, yeah. I mean, the short answer is yes. I mean, we always want to talk to investors, and we are having discussions with many institutions right now. And I think one of the things that happened was when we did the press release with Jefferies is that some people got the wrong impression that Jefferies was going to take the first $500 million of the entire platform, and that wasn't really the way that we intended the deal to be structured. Mm-hmm. And they, while the relationship has been great, they understand the need for us to diversify our sources of capital and want us to diversify our sources of capital because it just makes sense for everybody involved. So we are talking to several institutions now. We expect we'll start onboarding those institutions over the next several months and continue to expand and diversify the platform as we grow. With that said, we are looking for larger commitments, and, it just makes sense for us that from an efficiency and operating standpoint that, in our opinion, it doesn't make sense to deal. I'd rather deal with 10 guys that are each giving us 10 to 20 million a month than 100 guys that are each giving us 1 million a month. Right.
Yep.
So that's sort of been the idea, and, it seems to be working well. But yeah, anybody that is interested, certainly always willing to talk and want to keep the dialogue going because things change on a weekly basis.
Right. Okay. So then let's switch over to the borrower side of the equation. Like firstly, how many states are you open now for borrowers?
So we are currently in 25 states and should be in another 20 states over the next 90 days. Okay.
Wow. So you're really ramping that up. Okay.
Yeah.
So, and then what's the sort of criteria? You have a minimum FICO? What kind of borrowers are you attracting?
Right. So right now, the type of loan product that we have is similar to what you're seeing on some of the other platforms. So it's a 36-month and 60-month installment loan. Our cutoff for FICO right now is 660. We're using TransUnion. And the types of folks that we're seeing, I mean, we're certainly running up against people that you're seeing that are getting loans on other platforms, and it really just depends upon the channel that the borrowers are coming through. And the go-to-market strategy really was to go out with something that we knew was working, and there seemed to have a nice runway. And as we scale and as we get our core competencies down, we'll start to go outside of that ring fence and start to expand and differentiate and really make changes that will be more distinctive.
Okay. So are you talking about going down the credit spectrum with the changes, or are you talking about, what are you talking about?
Well, so it could be a little bit of everything, right? It's just the way in which we're underwriting now. We're coming up on our first yearly vintage. And while that vintage was much smaller than the ones that started in October, when we have enough data to really, take a look at things, we'll start to be able to make changes. We haven't really made changes to our credit policy yet, just because we haven't gathered enough data. So that'll give us opportunities to look at other credit segments. It'll give us opportunities to look at other addressable markets and determine whether or not we make more dramatic changes from where we started, which was to have more of a plain vanilla flavor.
Right.
I think that, we'll certainly be looking at other asset classes as others have, and have a few in our minds. There are a couple of other ideas for features or benefits that we might want to add on to our, or at least test in our unsecured product that you're not seeing right now in the marketplace. And, just to give you a sort of foreshadowing or a hint, one or two of those things may have been a part of the Lonio days. Mm-hmm. And, you never know. But the exciting part is that there is a lot of runway here, and there's a lot of opportunity and a lot of people that are in the credit space, and different segments have different needs. And I think ultimately it's about executing well and being able to, be good at segmenting markets. Right. And understanding those various segments of the market.
Right. How do you feel? I mean, you've talked several times. You mentioned that there's a lot of runway, and you've scaled from a pretty low level to $20 million a month. You're talking about $100 million a month. How do you feel about borrower acquisition? Do you feel you can still get get economies of scale as you grow? Are you? I mean, I know you're not going to give away any secrets, but I just wanted to think about I want to get some sense of how you think about borrower acquisition and the different channels, and how much runway there is in each of these channels.
Right. So, look, clearly there's a lot more competition today than there was 3-4 years ago. So that's why I'd mentioned, I think that it becomes even more important to be able to execute your marketing plans well, and being able to segment the marketplace and understand each of those market segments and give people what they want, right? And it all comes down to having a good understanding of the balance between origination, marketing, and credit. And, what's the right mix, and what's the right pricing. And, while many of the markets are very sensitive to price, it's not always all about price. And there are other value propositions that drive other types of borrowers. So it's about figuring all that out and doing it really well. I think that, from a runway perspective, and by no means is any of this easy. I think that we've spent a long time, and obviously even from my Lonio days, in understanding how to acquire a customer and how to acquire a borrower and what moves a borrower. And I think that it's certainly not easy, but I think that we've figured out the formula to some extent, and that's half of the battle. Many people or many organizations have spent tens of millions of dollars figuring out the formula, and that was one of the benefits when we talked earlier today about, what did I learn from Lonio? What did we do at Lonio? Well, I still like to talk about the third, fourth mover advantage, because we were able to do all that stuff and arguably, take 5 months of real operations and move the needle much further or to get to the point of $20 million that maybe it took some of the others, several years to get to.
Right. Yep. Fair enough. So, can you at least comment then? Is direct mail the major part of your operation, or is it online lead generation, or are you just how's it? Where's it fit?
Yeah. So, what I can tell you is that the majority of our volume has come from online channels thus far. And as we grow, we recognize that direct mail will become a component of the marketing mix. Mm-hmm. And we'll start doing that. But, like every other channel, it takes a lot of hard work and money and smarts and analysis and market segmentation in order to get it right. So, we think that online, offline, all those channels play an important role in the overall customer acquisition.
Right. So what would you say then is your biggest challenge today? You've got a platform that's clearly no longer just a startup, but you're not ready to, you're not at the scale of a Prosper or Lending Club. So what is your big challenge to try and get up to the next level?
Well, I think it has a lot to do with the way that we're marketing, also having more capital and having the right people on the team. And I think we've done a good job of building out a team and growing this business. The first thing I had to understand, or at least I think that a good CEO has to understand, is where do they not have strengths, and where you have to bring people in that are smart and know what they're doing in all these various areas. And when we started this business, I really had no credit underwriting background, so the obvious thing to do was to first go out and find a chief credit officer, and along the way bring in folks in respective areas that could really bring value to the organization as a whole. So we're now that we've really gotten things working well with our loan analysts and our call center and the operations, and we're at about 55 heads to date. Now the next challenge is to start dialing up and stressing the system to see how scalable it is. And along the way, we expect that we'll have mistakes we'll make, and things that we'll do, and if we're not, then we're not operating enough or doing things the right way, because you have to do things the wrong way at some point. So the challenges really are just getting out there, scaling, and executing the marketing properly, so that we could better understand our the consumer segments, and then also start to differentiate. So I think by the time we get to $100 million a month, we'll start changing our focus from customer acquisition and sales to branding, and really who is CircleBack and how are things unfolding. And one of the challenges will be as we get to forks in the road, and as we decide what's our next move, what's our next product, where who are we, where are we going next. Those will be the challenges, right? Trying to make those decisions and sleeping at night to make sure we made the right decision. Of course, in the back of our minds that always have us fearful is fraud prevention, right? Because fraud is something that's always a moving target. And at the end of the day, if you get hit with fraud, that could really create some serious damage to the company.
Right. Okay, one last question before I let you go. You obviously have thought about this, and I'm sure you've given presentations about this, but where is CircleBack? What's your vision for CircleBack in the long term? Are you comfortable being a number 3 or 4 player here? Do you feel like one day you're going to be bigger than Lending Club? I mean, what is the vision for the long term?
Right. So, people ask that a lot, and I think that in the world of consumer finance, where you have Bank of America coexisting with Chase and Citigroup and 6,000 credit unions, 6,000 community banks, and all these other players, we're happy to be in the 3rd or 4th slot, and we don't wake up every morning thinking, well, how can we beat Lending Club, or how can we beat Prosper, or how can we be number 1? I don't believe this is a zero-sum sort of network effect play for many reasons. And you don't see that in the brick and mortar side of the equation either. So for us, I think the goal is to just build a sustainable organization, build a brand, build something recognizable, and build something we could be proud of. And, when consumers think of us, we want them to think of, good experiences. We want them to think of quick service, reasonable rates, affordable rates. And, that goes a long way. So our goal is to obviously scale up to originations in the hundreds of millions of dollars, and be somewhere that you see Lending Club and Prosper today. But I also like to say that if we got to that level and then never grew any more than that, I don't think any of my stakeholders would go home and, be upset. I think they'd be quite happy, achieving that level of success. So, I still think we have a long way to go, but we're certainly on the right path. And I think we have a good foundation and solid base to get there. And that's what makes it exciting and keeps me getting up every day and coming into the office and, keeps me going.
Right. Well, on that note, I think we should end it. But I certainly wish you all the best, Michael. I don't think anyone in this industry deserves success more than you. You've really put in some hard yards over the years, and great to see you're on your way again now.
I appreciate it, Peter, and look forward to seeing you in a few weeks in New York.
Okay, at Lend It. Yes, indeed. Well, okay. Thanks for your time today, Michael.
All right. Thank you.
Okay. See ya. Yeah, Michael brings up an interesting question there at the end as to, really how many online platforms can this industry sustain? Now, it's certainly not going to be a winner take all. I think we've established that now. But how many platforms, I think, is going to be dependent upon how successful this industry is in attracting borrowers for the long term and how it scales. So, obviously there's a lot of people who believe, including myself, that we have got a lot of runway left, and eventually we're going to keep doubling the size of this industry every year for many, many years to come. So if you think about that, then you think, well, there could easily be 5, 10, 15, potentially 20. I mean, I don't know if there's going to be thousands like there is in the banking system, but certainly I could see 15 to 20 successful platforms in the consumer lending space alone. And I think CircleBack have a great shot at being one of those companies that are successful in the long run. Anyway, on that note, I will sign off. Thank you very much for listening, and we'll catch you next time. Bye.